Negatively yielding bonds are a curious phenomenon. Investment-grade munis are considered a risk-off asset class. How and when to use the tool is just as important as the tool itself. High-yield bonds, known as junk bonds, tend to move in high correlation to the equity market. This is a face-off Rieger report video on two intermediate municipal bond exchange-traded funds, or ETFs. As always, consult with your financial advisor. Should be one of your first steps. This is J.R. Rieger of the Rieger Report. Today I'm being joined by Justin Lowry, Chief Investment Officer of Global Beta Advisors, to talk about dividends in this wacky world. Justin, welcome to the Rieger Report.
Hey, thanks for having me, J.R.
Now, Justin, dividends are an important component of income from an investor perspective, and I've been watching keenly as the S&P 500 dividend yield has been going lower and lower due to the pandemic economy. Can you help us understand the current environment for dividends and what does the future hold?
Yeah, so let me just start by saying that obviously the global health pandemic, which resulted in basically what I like to call a self-induced recession, has resulted in a general uncertainty of some of these dividend-paying companies and their ability to meet the dividend obligations based on their cash flows. So what we look at is, what are some of the companies that have been able to sustain their dividends? And what we want to do is we want to build a portfolio that is more balanced. So when you think of the typical dividend portfolio, you generally think of the old telecom names, you think of utilities, you think of energy, and our portfolio construction process tries to introduce a multitude of names. Of course, we're going to find ourselves in the typical dividend paying sectors, but what we think is important is being able to span across all industries and try to pick up where maybe some emerging dividend payers are coming from. And you pointed out how the broad market in general, the yield in the broad market in general has been suppressed. And a lot of that has to do with two things. One, obviously, as we spoke about, companies generally haven't been increasing their dividends because they're preserving their cash, weathering this economic slowdown. And the other part is that the broad market index as a whole has been running up largely because of the information technology sector. So you have prices going up, but the dividends aren't matching the price appreciation in the stock market. So as a result, you have a suppressed dividend yield when you look at the S&P 500 in terms of a proxy for the broad market.
Yeah, that's very helpful. Now, there's a difference between quality dividend strategies and high yield dividend strategies. Can you talk about that difference?
Yeah, so this is kind of a concept that we're really trying to emphasize to investors. I think when investors are looking for yield, they just think, let me bring up a dividend portfolio and just buy it. And sometimes you have to understand some of the nuances that exist in dividend portfolios. So when I say a quality dividend portfolio, I'm talking about a dividend portfolio that doesn't necessarily look at the highest yielding securities. What they're trying to look at is securities that have been able to grow their dividends over a long period of time. So for example, the S&P 500 Dividend Aristocrats Index generally looks at over a 25-year period whether these companies are growing their dividends. Now, when you look at their dividend yield, it's a little bit underwhelming when you kind of look at it through the context of what you're trying to achieve here. So versus the high yield type of portfolio, I like to think of Global X's Super Dividend ETF where you have a 7 to 9% yield. But what that does is it just simply looks at the highest yielding securities and doesn't account for the fact that perhaps they may be unsustainable, they may be highly levered. So there's a major difference between types of dividend portfolios. And so what we like to do is we think that we're kind of threading the needle between the two. We don't want to sacrifice too much yield, but we want to make sure that there's guardrails in place to be sure that you're achieving that investment objective of a higher yield portfolio, but you're not paying for it with the additional risk that some of these higher dividend portfolio strategies employ.
You're employing these strategies with active management, or are you using passive rules-based management?
So we use a rules-based approach. And just to give you a little bit of background specifically of our dividend strategy is we start with the S&P 900 index. And as I touched on a little bit earlier, we want to create more of a diversified look at a dividend portfolio. So when we look at the S&P 900 index, we're doing two things. We're introducing large cap and we're introducing mid cap securities. And our research has led to the fact that there are just as many mid cap paying dividend paying securities as there are large caps. So you're not sacrificing potential dividend paying stocks by introducing mid cap securities. And so once we get through that process, we look at the portfolio, we start with yield, we look at what are the higher yielding securities, but we're not just looking at the current 12-month trailing yield. We're looking at the 12-month trailing yield for each of the 4 quarters that precedes it. And we're taking the average there, and then that's the subset that's introduced into the next phase. And from there, we're looking at all 11 GICS sectors and figuring out what are the highest dividend paying securities within each sector to try to create on a selection basis some diversification in the portfolio. And then the last component is we're weighting those securities by revenue. And by doing that, we're creating a better value portfolio, in our view at least. And a couple of the guardrails that we put into the portfolio is that we cap energy at 3% when oil futures fall below their 30-day moving average. And the reason we do that is that's an indication of the lack of profitability that may exist in the energy sector. And then the last part is that we're looking at securities that may have cut their dividends or announced that they're cutting their dividends. And again, that's an indication that these companies are not able to sustain their dividends and may be facing some cash flow crunch.
Why is valuation important when evaluating and purchasing a dividend stock?
People look at dividend portfolios and dividend stocks as already valued. That is true when you pit it against the general broad market, because the general broad market is generally more expensive because you have investors paying for more growth-oriented stocks that may exist in a broad market index. But when you compartmentalize it down to just the dividend landscape, some of these dividend portfolios are actually trading a little bit higher than their historical average. So it's our objective to make sure that we reduce those valuations, and we do so with that revenue weight component. In fact, part of our research is that we looked at the S&P 500 index over a period of about 30 plus years, from 1985 through the end of 2019. And there's actually nearly a 90% correlation between price to sales and a forward 10-year looking return. So we believe that in general, valuations are a high level predictor for forward-looking returns. So that's why it's important. Obviously, people when people invest in dividend portfolios, they kind of want to just sit and collect the income. But the underappreciated part is that you can get capital appreciation on top of your dividend income. And I think it's important. And it also kind of insulates you from potential downside risk as well.
The name of my boat is total return, so I think we have to keep that in mind, absolutely. With a change in presidential leadership coming, are there any potential tax changes that could impact the way we should be looking at dividends?
Yeah, so I think that's a concern for everyone. And in fact, I think, once President-elect Biden won the nomination, there was concern that perhaps maybe investors take some of the winners of this year and sell it this year and lock in the capital gains rate this year. Of course, with dividends, dividends are taxed at an ordinary income rate. So if the Biden administration does raise taxes for the households that are making over $400,000, you will see an impact on dividend income being taxed. Now, the key here is the Biden administration may lift some of those state caps that the Trump administration put in. So if you're living in New York and California, perhaps it's a net wash if they get rid of the state tax write-offs and you can write off more of your federal income tax at the state level. The other part is that I'm sure there's plenty of lots that people are sitting on losses right now. So you can offset some of the dividend income with some tax loss harvesting. So there's a couple of potential ideas to or potential possibilities where it won't be a total sticker shock. But I would caution to some degree that there could be, some tax consequences in 2021.
Hey, Justin, thanks for jumping on this interview. Your insights on dividend investing is really important for people to hear. How do people find out more information about Global Beta Advisors, your research, and dividend investing?
Yeah, so I would ask people to visit our website, globalbetaadvisors.com. From there, you can explore all of the research that we've built. We post insights fairly regularly, and you can also follow us on LinkedIn, Twitter, or Facebook. Thanks again, Justin. This has been a Rieger Report interview with Justin Lowry of Global Beta Advisors. For more information about income investing, please join me on LinkedIn as well as on my website, straighttalkaboutbonds.com.